Welcome back to Candlelight, where price and mechanical function. This is the second video on what is obviously a two-part video on chart patterns and what chart patterns are, but more importantly, I want to cover why and how they work, because they happen all the time on a very consistent basis. And they happen in all markets. It doesn't matter. Crypto, futures, currency, stocks, it's all the same. A lot of people trade structures or trade the markets on just on the fact that there is a structure in existence, and that's the very last thing you want to be doing. You don't want to be looking for structures and then trading those and just trading off those structures just because they happen to occur. It's going to set you up for failure, and the reason why, it's going to automatically place you in a position where you're buying high and selling low, and you literally want to do the exact opposite of that. Right? You want to buy high, you want to buy low and sell high. And you want to sell high and buy low if you're going short. It doesn't matter. But if you just trade structures, and if you trade it the way, trading structures is taught, again, you're going to be caught in that trap. So I want to go over not only what the structures look like, but also how people are being taught to do that, and how there's a better way of doing it, or there's a better way of being set up for success instead of failure. Now, in the first video, I went over reversal patterns. In this video, I'm going to be going over continuation patterns. I'm going to be going over the most popular ones because, I mean, there's quite a few, but the obscure ones don't happen that often, so there's no point in covering those. So let's just cover the most popular ones, because those are the ones that happen most of the time. So I'm going to be covering bullish and bearish rectangle, which are rally-based rallies and drop-based drops, and I literally talk about those formations in pretty much every single video I've ever put out, because they happen all the time. So we're definitely going to cover those, or that one, or those. I'm also going to be going over bullish and bearish pennants, and they're pretty much the exact same thing as ascending and descending wedges. They're very, very similar, and the mechanics work the exact same way. So I'm just going to go ahead and kill two birds with one stone, and just talk about bullish and bearish pennants. Which is definitely a form of rally-based rallies and drop-based drops. The mechanics again work pretty much the exact same way. I'm gonna cover ascending and descending triangles, and then cup and handle and inverted cup and handle. So we're gonna cover what those look like, how and why they work, because things need to occur for those structures, or for all these pattern structures to occur in the market. And the only way we get those is if those things those mechanics that need to function to create those patterns happen just as often as the patterns themselves. So let's understand why they work, and then that way you can be using structures and patterns the way you're supposed to, which is using them as confirmation on a trade that you should already be in on. Something I covered on the last video was, don't trade structure just because there is one. You're gonna get slammed. Already be in a position, and then if you have confirmation by, oh, I got into a head and shoulders, so to speak, reversal pattern, I went over that last video, then that's just extra confirmation. That just makes you feel more more cozy and comfy about the position you just took. So what they look like, how and why they form, what people are normally taught on how to trade it, how you should be doing it, and how there's definitely a better way to be going about how to understand structures and how to use them to your advantage. So let's jump right in. All right, so the first pattern I want to be going over is a bullish rectangle, which is a rally base rally. This is a very popular formation, happens all the time. If you notice all the highlighted areas, and these are only just a few of many that are just in this uptrend alone. And you'll find these in uptrends. Since it's a continuation pattern, you'll find them in uptrends to the upside, because it's a bullish formation. So I'm going to be talking about this green highlighted area right here. Now, just to clarify, these three charts, my left one is a daily chart where every candlestick represents one day. My center chart is a 240-minute chart, so that's every candle represents 4 hours. And then my right-hand chart is a 60 minutes, so that's 1 hour. It's always good whenever you're looking at any market, doesn't matter which one, to have multiple time frame analysis. Have big picture, and then make it smaller and make it smaller, so you have a much better understanding of what's going on with price action. So I'm going to be going over a bullish rectangle, and the next one we're going to be going over a bearish rectangle. So this one I want to be covering right here. What you're normally taught to do, and this rally base rally, which again is a bullish rectangle, but there's a much better way of saying a rally base rally, and basing because it just went sideways, and then rally because demand then came in. There was a balance or equilibrium of supply and demand, and then an imbalance of demand, obviously because it went to the upside. So that's an area where there is more demand than supply. When price comes back into this market or into this area, there's demand here, so price rallies. But I want to show you what you're normally taught to do. This rally base rally on a daily is this rally base rally on a 240. Okay, rally base rally. This is the area that we're gonna talk about. What you're taught to do is whenever you have any form of basing after a rally, you're taught to catch the breakout, which is not only difficult because always in hindsight you're like, oh well, it was on this point and this is just a little escape, and then it came back down, and obviously you would have gone out like you would have gotten the breakout at this point. That's a lie. I mean, price moves very differently in terms of perspective whenever you're trading live and you don't have the 2020 hindsight of seeing it in past tense. It's much different trading live than it is trading on price action that's already occurred. So this is why you don't want to be doing what you're normally taught to do. What you're normally taught to do is anytime you have basing, you're normally taught to buy the breakout. So you're going to be told to buy right here, or, and let me make this a bit bigger. There we go. You're normally told to buy the breakout right here. You're taught to buy the breakout or the retest. The reason that makes no sense is if you go long here, your nearest area of demand is look down and to the left. There's a video about that. And find your next your most current demand zone, which is where ballistic movement rose to the upside, and it's the most current one. So right here is your nearest area of demand. If you bought here, you'd have to put your stop loss one tick below this swing low right here. You always trade with a stop loss. For the same reason I said this in the last video, for the same reason you don't buy a gun without a safety. It's just, you just don't do it. You just don't do it. You want to keep your account safe, so you need a safety. You always trade with the stop loss. And every position you go into, you only risk 1% of your portfolio. So if you go long here, that's a very large area. And you have no demand zone right here because this is a pocket of air. This is just ballistic movement. There are no demand zones in this rally right here. So you're going to put a whole position that's this big for you to just get 1-to-1, right? For you to just make 1%, or like the same amount that you risked, which is 1%. Price would have to rally all the way up here for you to just be at a 1-to-1. That's a huge area. And if you don't use a stop loss, then my goodness, you're just setting yourself up for failure, period. What you want to be doing is buying low. But when it comes to rally base rallies, for the same reason that you want to buy low when price enters an area of demand, and let's just use this. It's not that great, but just it's the closest example, right? Or actually, let's just use this one. This is where demand exists because price moved ballistically from that area. It's an origin of a large rally. There's overwhelming demand here. So when price comes into demand, that's where you want to be buying. You don't want to buy this rally. There's no way you could have known. Price was coming down. It rallied and then it made a lower low below this low. Price was in a downtrend. You don't buy downtrends, you buy uptrends. Once this downtrend right here got broken by this demand zone, that's where you want to be buying. You want to be buying in areas of demand. Right here on this rally base rally, this rally right here, it's a pocket of air because there are no demand zones. It's just one solid rally. There's nothing to tell you to buy here. So you would have never have known to have bought in this area, right? Which is why you don't want to be buying the breakout. You want to use this as an area of demand in the future where price will come back down. And sure enough, I'm going to take you back to the daily. Price did exactly that. It came right back into demand. That's where you want to be buying. And just to bring home the fact that you should use structures and formations as confirmation. In the last video I went over reversal patterns. This shoulder, head, shoulder, that's an inverted head and shoulders. Whenever price breaks this downtrend, because you want price to come back down into demand, it's going to have to do that by being in a downtrend. The area, the demand zone that broke your downtrending trend line happened in an area of demand. Then when price re-enters that area of demand, you want to buy, you buy right here, and you end up buying the right shoulder. And whenever price makes a higher, a higher high, or breaks the top of this basing or the top of this supply zone, then you caught the right shoulder of this inverted head and shoulders. So it's just confirmation that you got the right one. That's how you want to be using structures and patterns. Is if you're already in a position, then that's what you want to be seeing as confirmation. So you don't want to be buying the breakout, because one, you're also coming up into supply, right? You have mass amount of supply right here and on higher levels right here too, right? This is the top, this is the swing high of this massive drop. Let me put this in red just so no one gets confused. These are areas of supply. You don't want to buy high. If you're buying after a rally, then you're buying when you're approaching or coming into supply zones. You want to buy after price comes back down in an uptrend, which again would be here. So buying after the breakout of here, yeah, this time it just happened to work. But this is why I also pointed out these three yellow areas. This is when it doesn't work. Do you see this rally, base, rally? Let me make this bigger. Rally, base, rally. This is a bullish rectangle formation. If you buy at the breakout right here, then price went a little bit your way, but where are you at that point? You're in overwhelming supply, which is why you're going to get smashed. Price comes back down. Where you want to be doing is buying low in demand. Origin of ballistic move to the upside right here, and the swing low of this move. That's where demand is. The origin of large moves to the upside. You want to buy down here, right? So if you're using the formations, these structures, just on the fact that they're structures themselves, you're going to get smashed not every single time, because it did work up here, but you'll see, rally-based rallies or bullish rectangles are all the time. But you need to know where you are, and if you're just using them and if you're just buying them or trading them just because you see one, a lot of times you're going to be in a bad place, because you're going to be buying after a rally in price, which is going to put you in an area of supply, which it came into, and then it went against you. And here we go. This is the on a 240. This is the rally base rally, or the bullish rectangle. You might have gone long here, but it goes your way, and then it just comes right back down against you. That's not something that you want to be doing. And then if you do use a stop loss, then if you do buy at the breakout right there, then your nearest demand zone is right here, after having bought the breakout right here. So you bought here, you have to put your stop loss below this swing low. You're risking this whole area. You're only up maybe, yeah, let's just say that you sold the swing high. You're up 1.5, maybe 2 to 1. And I mean, like, that's just not that great. So that's why you don't want to be trading these breakouts. You're going to be set up for failure, just because using it here, you bought the breakout, you're coming up into supply. This rally base rally or bullish rectangle, you buy the breakout, it goes your way for a little bit, and then hey, you're once again already in supply at this point. It goes against you. Right here, rally base, this little tick, right, or not little tick, but this swing high right here, you would have bought that. And then it goes against you, and then it goes your way. Well, I wonder why. Well, it's because you once again are in supply. The origin of this swing high, which is the origin of this ballistic move to the downside. You're buying in supply. You don't want to be doing that. You want to be buying low, and using these areas of rally-based rallies as demand zones. And then when price comes into these demand zones, it's going to have to be coming down in a downtrend. Wait for that downtrend to break. Waiting pays. I have a video about that, and it shows you exactly how to do this. But if you have an area of demand, wait for this process to occur. Let it come back down into that area. Let price, break that trend line in that area of demand. If it doesn't happen in this area of demand, it's not valid. Don't take that zone. And the origin of the rally that broke this downtrend, well, that's your example right there. You want to be doing that. You don't want to be buying after a rally in price, like right here. You'll be smashed. It'll come back down to bite you in the butt. So now let's go over a bearish rectangle, which is also a drop-based drop. Let's cover that. All right, so this is what a bearish rectangle should look like. It's a drop, price bases, and then it drops again. That's what this area in red looks like. Drop, base, drop. What you're taught to do is when price breaks below the basing, right there. When price breaks below the basing, you're taught to short the breakdown. That's not what you want to be doing at all. You don't want to be selling low. You want to sell high, both for exiting, for a long position, and also for shorting. If you short, you also want to sell high because you want to catch as high as possible so you can take the whole swing, swing down. And if you're in a long position, you want to sell to exit. You want to buy low and sell high. So you don't want to be catching any direction or any move of a move that has already occurred. So you don't want to be catching this breakdown. What you want to be doing is selling in an area of supply, which is way up here. After price has already moved down, it's already made the move. You've already missed it. You've got to learn how to just, make a Queen of England, which is wave goodbye. Right? You don't want to be catching this breakdown for the same reason that I explained on rally-based rallies. The move has already been made. You're already coming into massive amounts of demand. Now here, just price just happened to have continued the downtrend, right? But that's origin of massive demand. If you're selling here, you don't have a lot of profit potential. And once again, your stop loss, or you would have had to have risked this whole area. So you would have shorted right at the bottom of that rectangle, and your very next supply zone is all the way up here. You would have had to put your stop loss way up here. For you to have made just a 1-to-1, price would have had to move all the way down here, and you're just at 1-to-1 to what you risked. That's a huge area the price had to move. You don't want to be using these areas to go into a trade. You want to be using drop-based drops as areas to re-enter. Perfect example right here. And it works the exact same way, on the rally-based rallies. You don't actually trade these guys. You don't trade this breakdown. It's just not a smart thing to do. You want to wait for demand zones to be broken, such as right here. It broke. Let me make this just a little bit bigger. Price broke it by a little bit, but that's all you need. After price is now making lower lows because it broke this swing low, now you're in a downtrend. So you just wait for price to enter areas of supply. You have one right here. It's beautiful. Then you short. You use these as areas of supply. You don't actually catch these as they're happening. That's the last thing you want to be doing. For this exact same reason, and it's a mirror image of the rally-based rallies or the bullish rectangles. If you have a drop, base, or rectangle, and then drop, and you catch, like the drop of that swing low, which would have been right here. That swing low would have been, let's just say, right there. And again, I love how hindsight, this is obvious how you would have done, but this would have been a very different story. If you would have shorted here, it would have gone your way a little bit, and then you get smashed, right? Why? Because you're already in demand, which is why you don't want to be using these as the reasons to go in. Yeah, that's a drop-based drop, and that is a continuation pattern, but price doesn't always do doesn't always do what it's supposed to do all the time. In an area of demand, price is going to rally. The same thing happened right right here on this yellow square, you have a drop, base, drop, price, bounced, would have stopped you out or would have taken you out for a loss, and then it goes your way. Well, just because there's a structure doesn't mean it's it's going to work every single time. It's a lot safer to use these structures as areas of supply, since we're talking about drop-based drops or bearish rectangles. And then within those areas, which would have been right here on a daily, that would have been your area of supply. Within this area of supply, you have two supply zones. You have the origin right here, and you have this one. Well, hey, you just short supply zones right here when it re-enters them, and then price will go your way. And now you're selling high, you're shorting high, so selling high, and you can now start to buy very, very low for a massive amount of profit. That's what you want to be doing. It's a lot better to have sold way up here than to sell way down here, because when you sell when price is down, price is in demand, it comes back up. If price is high, it's in supply, it falls from there. So those two are your bullish and bearish rectangles, and these areas occur because right where you have these legs, within this fall, you have a drop, base, drop. It fell because there's an area of supply right here. That's how you get these structures. There's your swing low. You have a drop. You have the supply zone that broke this swing low. It fell, so now you know you're in supply. When price re-enters that, for the exact same way that you trade this, when price re-enters this supply zone, that's when you short. You don't short this breakdown right here. You wait for price to fall more, then rally into that area of supply, and then it continues. See how it happens once right here and then twice right here? It happens on all time frames all the time. These structures happen all over the place all the time. You just need to know how to do it. You don't catch the initial drop, base, drop. You want to catch the retest of those areas. And the exact same is true, except in the inverse for your rally-based rallies and your ascending or your bullish rectangles. It works the exact same way. So that's why they work, is within these areas you have supply zones that broke swing highs or swing lows. Those areas need to be respected. When price re-enters those areas, the trend continues, thus giving you your structures. So now we're going to be going over bullish and bearish pennants. So this is what a bullish pennant is. Again, it's a continuation pattern, so it's rallying. You have a rally, and then you have pretty much a wedge. A wedge would be something very similar, except it's not really quite closed. It's more like open like that. But you can understand how the mechanics work the exact same thing. It's practically identical. But in short, price is just getting pinched. Just think of it in terms of a spring, where as time continues, price is just getting pinched, and it's much like a spring or a coil. It gets to the point where, okay, it can't be held anymore, and then ping, it'll either go to the upside and continue the rally, or it'll fall to the downside and be a reversal. Most of the time it's a continuation pattern, but if you understand how they work and how you're supposed to trade them, you won't catch the breakout or breakdown like people normally tell you to do, because then you don't know. If sometimes it rallies a bit and then it falls, price will do its thing. But if you let that rally, that price pinch of supply and demand, and then that rally, then you're given a demand zone. So when price re-enters that in the future, then you have a high probability of this is an area of demand, instead of trying to guess the breakout or breakdown. So this is how it works. So that's how it looks, and we're going to be talking about this area right here, this rally, and then again, this pretty much you can call them all rally-based rallies. It's a form of basing, right? I normally just, anything that looks like a rally-based rally, whether it's a rectangle or pennant or wedge, it's a rally-based rally. This rally-based rally is this rally-based rally right here, and you can kind of tell how price is getting pinched right here. And again, price doesn't look as perfect as it normally does on those poster representations, but you can kind of tell how price is starting to have that pinched feel where you have an uptrend and a downtrend converging, and then you get the breakout. Well, what you're normally taught to do is catch the breakout. You're taught to catch the breakout of the swing high, right? That's, well, once again, you don't want to be doing that. If you did buy right here at the breakout, do you see how price rallied, then came all the way back down, and then it started to rally? Guys, that's your area of demand. You want to be buying down low. Right here, you have your rally base rally. So your bullish rectangle rally, basing, and then ballistic movement out. Area of demand. You want to buy low. You don't want to buy the breakout. That just doesn't make any sense. You're buying high, and then at that point, if you buy high, where are you? You see this drop, base, ballistic movement? No coincidence that price fell from that point. There's supply right here, and that's where you're going to be buying into. Bad idea. So you don't want to be buying the breakout of these areas. You want to wait for price to re-enter these areas. And in this case, price never came back down all the way down into this area. You see how price just continued to go, continued to go. Price re-entered this rally base, rally, and then within this basing, you have a very tight basing right here. That's your basing, and then it came back down. So in this case, price never came back down. Once again, make like the Queen of England. Wave goodbye. There are a lot of other stocks, a lot of other markets, and a lot of other areas that are, or areas of demand, if you're in an uptrend, where you can definitely catch the uptrend whenever price comes back down at a higher point. Sometimes price doesn't come all the way back down to your specific area, but other areas, if it's in an uptrend, demand is going to need to be breaking areas of opposing supply that happened before. The only way it can break opposing supply is with demand zones. So you're going to be getting them as price rallies, and then you just trade those demand zones, like I just showed you there. So not all the breakouts, or not all the areas of demand that are formed by those rally-based rallies or pennants or wedges get retested, but you'll have other areas that you can jump in as well. But this definitely does not mean that you should be catching the breakouts of those areas. Just because it happened here on the last example on the rectangles, I think I made my point. I could give you multiple examples on how you would have gotten smashed if you would have caught the breakout. Don't do it. Wait for price to come back down into those areas. And if it doesn't come into that area, you'll get rally-based rallies a bit higher up that are good demand zones as well. Catch those. So that's how they look. This is a real life example, rally-based rally, or you have your, kind of your downtrend and uptrend happening at the same time. They're converging. You're taught to normally buy at the breakout of the swing high, right? Of the breakout here. You don't want to be doing that. In this case, it did happen to come back into demand. But what you want to be doing is using this area in the future where if price comes back down into demand, I'd tighten it up and say it's about there. That's an area of demand. That's how you want to be using that. Wait for price to come back down into here and then take it long. Don't catch the breakout and then get smashed whenever price comes back down, because by then you're buying high and then selling low, which is not what you want to be doing. So now let's go over a bearish pennant, which is again another form of a drop-based drop. All right, so this is a bearish pennant, right? Which is the inverse version of the bullish pennant we just did. You have a drop, you have a pennant, and then a drop. This is just another form of a drop-based drop. The mechanics work the exact same way. I'm going to be talking about this formation right here, where you have a mini uptrend, a mini downtrend, price is just getting pinched, and then breakdown. And what you're normally taught to do is catch the breakdown of, actually I'll just do that, catch the breakdown of this area right here. So you would have shorted right after, and I got the wrong arrow, you would have shorted, if I can get the right arrow again, there we go, you would have shorted right here. Now right at this, or this particular scenario instance, price gapped. This probably was a weekend, so this was Friday, and then Monday there was a big discrepancy, so price just gapped to the downside. That happens a lot with stocks, not so much with with currencies, but it does happen. But let's just say that that price did trade through. It happened to have worked for you right here. But here's another perfect example of why you don't want to be, again, selling low. You want to be selling high in areas of supply like this drop base. So drop base drop. That's where you want to be selling. You want to be selling high, not selling low. And for exactly this reason, in fact, we went over this last example where you have a drop base drop. You would have shorted the bottom of this basing, but you're already in supply. So you would have gotten smashed on that one. It doesn't mean just because you see a formation that it's going to work or you should use that as a reason to get in. You should what you should be doing is using it as confirmation. If you did short up here where you're in supply where you want to be shorting, if you did short here and you were able to draw these two lines, and again in hindsight it's really obvious how you would have drawn the first point on this trend line, the second point here, although there's no uptrend right here, but a lot of people think these formations are easy to identify when trading live. It's not. But let's just say that you did. If price did break below this swing low, then you have confirmation of already being in, that you do have a pennant or a bearish pennant, which then makes you that much more comfy to stay in the trade and then wait for price to just continue to fall. But even so, it's a lot better to have shorted here than to have shorted the breakdown, because here you're in supply. Here, well, we were in a downtrend, but there are a lot of circumstances where you're already you're in demand, and that's the last place you want to be shorting. So they occur because, again, this drop base drop, you don't want to be shorting these drop base drops or these pennants. In fact, for future reference, just like the bullish pennant, you want to be using this in future areas as an area to go short. Once again, price never came back up into that area, but you can always, well, hell, right here. Again, this is not a pretty area, but this is your area of supply. Again, that is very, very, very ugly. Not something I would have shorted, but it's there. This is the origin of this ballistic move, right? That's the candle of control. There's no arguing that fact. But the problem is it's just so ugly and so huge. That's catching this would have been very, very interesting. But this is where you want to be. This is where supply exists. This is where you want to be shorting. Now, price didn't re-enter that area, but again, you have a lot of other markets, and if you were already short, again here, you're looking pretty. If you shorted up here, then you're already in this move. In fact, you would have added to your position if you would have shorted again right here. So use it as confirmation to already go into a trade, and yeah. Exactly what I was saying. You don't want to be using these pennants or these rectangles or all drop base drops and rally base rallies as reasons to go in for exactly this reason. You didn't want to short this drop. You wanted to wait for price to come back up into this supply zone, then short it. You want to be using these areas as a reason to go into a position whenever price goes or re-enters them. So that is bullish and bearish pennants. Now let's go over ascending and descending triangles. All right, this is an ascending triangle. This is what it looks like. It's a rally and then a triangle where the uptrend or the lows are in an uptrend, and then supply is remaining it remains stable. So it's not like a proper uptrend where you have higher highs and higher lows. Your highs remain the same, but your lower lows are slowly ascending, and then you have a breakout. It works the exact same way as the pennant or the wedge, where price is just, as time is progressing, is just you're getting pinched. In this case, it's to the upside, and like a spring, it'll eventually pop to the upside, right? But again, you also seeing there are also reversal patterns where that means that price is rallying to reverse to the downside, where it's a rising wedge, which is almost exactly the same as an ascending triangle, where it gets it's getting pinched and then price falls. So then you're just playing a guessing game. Might as well wait for price to pinch and then release to the upside, give you a demand zone, and then wait for price to come back down. Don't catch the breakout. In this case, it did occur, but a lot of cases it doesn't. But I'm going to show you how and why this works as well. So this is the area we're going to be talking about. You have your rally, and then you have your ascending triangle. And you have your ascending triangle because you have an uptrend right here, So your demand zones are being respected and supply is remaining the same. Now they occur because as price is rallying, so here you have a low, a high, a higher low, and a higher high. You're in an uptrend, and where is the origin of demand? Down here. There's demand, so it made a higher high. Now you're in an uptrend. So when price comes back down into demand, that's where you want to buy. And then I went over this on my video of the characteristics of legs. This leg not only respected this demand zone, but it has rally-based rallies. It broke an opposing trend's supply zone or swing high. It broke its own mini swing high. In fact, I'm going to go to my 240. We're going to be talking that leg that we're talking about is this one on a 240 minute. This leg. So it broke this swing high or that supply zone. So that's the opposing trend's supply zone or swing high. And it also broke within its leg, it broke this swing high, which is its own little mini supply zone within the leg. So it broke that, and it's the origin of strong demand. It didn't make another complete swing high, but it's also another really good leg. So there you have that demand zone, the origin of that move. And then it comes back down, and this leg broke opposing trend supply zone or swing high, which is right here. So then this leg or that demand zone gets respected. As you're rallying, notice this is what an uptrend is supposed to look like. Demand zones are being respected, and supply zones, such as this one right here, this one right here, and this one right here. This third one's not so obvious. I can see it off the get-go, but anyway. But these three supply zones get broken, so supply zones are getting broken. Maybe not this top one, but that's why you have an ascending triangle. But the most important thing is demand zones being respected. So you're not just getting this formation just because. You're getting it because demand zones are being respected, and that's why you're getting the ascending triangle, and supply is just being chewed away. You get your initial supply zone when price re-enters. Most of the sell orders here get used up because price enters and then falls. And notice every time price comes into supply, the fall is less and less and less because there are fewer and fewer leftover sell orders in your supply zone that are left after every single touch is made, or is after every single touch in your supply zone. So supply is just being chewed away while demand is being increased, and then you get your pop to the upside. So right here, just to kind of drive home the fact of wave goodbye, that's your last demand zone, has not been used, and it's really good. It's the origin of this massive rally. So you were waiting for price to break above supply, then come back down, retest this area, and then go long. It didn't. But this is when now you're in an uptrend. Well, you have another really good demand zone a little bit higher. So you might not have been able to catch this demand zone because price didn't come all the way back down here, but you're given this one. So, wait for price to do and exactly what we talked about, what it's supposed to do, which is come back down into your area of demand, wait for price to break the trend line, and it does, and then you go long that demand zone. But just because you missed the first one doesn't mean you can't re-enter. You just get some really good demand zones that are a little bit higher, and then wait for price to do the exact same thing. But you don't want to be buying high, because once again, we were talking about this area right here. Remember that ugly area? This one? That's kind of what kind of kept this whole area right here. It happened in this general area which we talked about, and then it got more specified right here. But if you buy right at the breakout right here, you're in general supply. You don't want to be doing that. You don't want to buy after a rally in price. You want to wait for price to come back down into demand and use the areas of demand that break these formations as areas to go into in the future if and when price re-enters those areas. So that's how an ascending triangle looks and how and why it's formed. Let's go over what a descending triangle looks like. All right, and this is what a descending triangle looks like. You have a downtrend, and then you have the mirror image of an ascending triangle. You have a triangle where the downtrend is being respected. You have a downtrending trend line, but supply demand is staying the same, but your lower highs are being respected, and they continue to come back down. And once again, price is getting pinched as it gets as it gets closer to that breaking point and then explodes to the downside. That's what it's supposed to look like. So here I'm going to be talking about this this area right here. And again, it doesn't look like a continuation pattern because this is some examples I show you where it works out, and then some examples I show you where you would be shafted if you use the methodology that most people, 99% of people that show how to trade patterns tell you how to trade it, how you're going to be destroyed. And this is why. This is a case where it didn't work. By the way, this formation that we're about to talk about, this is your cup and handle. We're going to go over that right after. It's the very next one. Area of demand right here. Beautiful. Why? You have ballistic movement out. Good area of demand. In fact, that's your entry on the cup and handle, not the breakout of this point right here. But again, I'm going to cover that in a second. But that's your area of demand. Just because you have a structure does not mean it's going to work every single time. You need to know where you are. You're in areas, you're low on the price curve. And price curve this is your swing low, and that's your next swing high. Supply is all the way up here, guys. This is where price falls from, or supposed to fall from, right? And you can kind of tell. That's general area of supply. This is general area of demand. Let me paint this red just so there's no. So on the curve between the low and the high of the supply and demand curve, you're way at the low. You're where price bounces to the upside from, not where price falls from. It falls from all the way up here. So you don't want to be just shorting a descending triangle, which is where you have here, just because there is one. That is not, just because you have a structure or this pattern doesn't mean that's a reason to go in. What you want to be seeing is this, or I'm sorry, let me show you what you would have done if you would have followed what everyone says to do on trading patterns and all this stuff. Here you have your downtrending trend line, and then you have your demand that is staying the same down here. What you would have done if you would have followed directions exactly, here you have the low of the basing. You're supposed to short the breakdown of this swing low. So here, one tick below, and again it doesn't look that big, but let me make it a bit bigger. There you go. You would have shorted right here. You would have taken this short, and then notice how price rallies all the way back up. Hey, guess what? Into an area of supply where you should be shorting to begin with. This is where you want to be shorting, but you were told to short down here. You take this massive loss. If you're trading with the stop loss, it would have stopped you up by then. Like, that's just huge. Or you would have your stop loss right above this supply zone, to be honest, but that's just ginormous. And then when price comes back down again, let's just do that, you shorted again the breakdown, and then price rallies all the way back to the upside and starts this massive uptrend from that exact swing low where a lot of people are told and are taught to short from. You don't want to short the breakdown. You don't want to sell low. You want to buy low. And in fact, that's an area just cover this. That's an area of demand. That's where you want to be buying to the upside if you didn't catch this cup this cup and handle. That's where you want to be buying. This was an area of demand where when price re-enters, that's when you go long, or you can go long there, and then the actual really good position or really good entry was here. That's where you really want to be going, which is where you get the really good ballistic movement. That was the going long here, like that was the advanced trade. Advanced trade is here. Beginner trade is right here. And the reason you get this, and the reason you get your descending triangle is exactly because of this, or what causes that formation is you're in a downtrend because you have like a swing high, swing low, lower swing high, lower swing low. You're in a full-on downtrend. You want a short supply zone. So what do you do if you have, let's just say current price is right here? Well, look up and to the left. Well, your immediate ballistic move is right here with a drop base drop, or that's a form of a bearish rectangle. You don't want to catch the breakdown of that rectangle. You want to catch the retest, and here it comes in. And because you're in a downtrend, supply zones are being respected. Now this swing high is going to be respected when price re-enters that, and demand is going to be chewed away. When a price comes down, it bounces, and then it comes down, it bounces and breaks, and then you're getting your downtrend. But just remember, your overwhelming location is in your daily low on the curve demand zone. So, but that's how it's formed. It's just supply zones that are happening are being respected on the short-term downtrend, and that's why you get the lower highs or the downtrend angle on the right, and then your demand is just flat because it's getting chewed away up until the point where it really breaks out from, and then you just wait for price to come back, and let's see if it actually touched this. Oh, there you go. Well, even if it didn't hit that, again, I'm not going to cover in this video, but that was right here. That was a really good demand zone. And then within that, I guarantee you within a 5 or 10 minute demand, that mini wick right there, that was your demand zone, which price came into. All right, so there we go. So yeah, that's why you don't want to be buying low. You don't want to be buying the breakdown. Just because you have a formation doesn't tell you anything other than there's a formation. You don't trade the images, you don't trade the patterns or structures, you use them as confirmation. This is a perfect example of how if you do, you'll get smashed sometimes. So now let's go over a cup and handle. All right, so this is what a cup and handle is supposed to look like. And I can only work with straight lines. So this is a rally. This is supposed to be a nice, gentle, U-shaped, kind of a horseshoe kind of looking figure, but I don't have curves, so I just did straight lines here. But here you have, it's a continuation pattern. So if you're in an uptrend, you're going to have a fairly large dip, and then it makes a higher swing high. So this swing high will break this one, comes back down for a lot of people call a retest, just on the very fact that, you'll see on Google, just type in cup and handle, you'll see this where that's your line. It comes back down just on the area of the line, buy for no other reason than just because there's the line there. I'm going to show you how and why that actually happens and the reasons why this structure occurs. But you buy that pullback into an area of demand, and then it continues to the upside. So that's what it's supposed to look like, with a bit more of a horseshoe-like shape. So let's go over why and how it actually works. Okay, so this is, again, it's the same one. I shrunk this down so I could have space to draw this out for you. This also happens to be a head and shoulders, and a lot of head and shoulders look like cup and handles, which is, again, another reason why you should definitely not be paying attention to just structures, because you'll get confused with a whole bunch of stuff. This is your uptrend right here. That's your first swing high that needs to be broken. So it comes up, price falls, you get this nice gentle slope, which is also head and shoulders. I went over in the last video. You get a nice fall, and then you get the leg up, so it breaks above this swing high. This is one of the few times when the pattern doctrine does not tell you to buy the breakout, but to come back down for the retest and then buy. But what it does tell you is this: you're supposed to buy. Let's just go to the 240 right here. This is that swing high. It tells you that you're supposed to buy the retest of that line, which doesn't make any sense, because, I mean, pivot points do, like they definitely do exist. But here's your area of demand, guys. And again, it's kind of scrunched up. You can definitely tell this is where ballistic movement came out from. So the reason why this occurs, back to the daily, you have your rally, your ascending triangle, and then your rally-based rallies. And again, notice how this uptrend kind of has most of the examples. Like, that just goes to show how often patterns occur. I mean, within this 6-month period, you have many patterns and formations that occur. They happen all the time. But if you're in an uptrend, then this is, this is kind of your swing low, your swing high, your higher swing low, and then it breaks above your most current opposing trends swing high. So now you're definitely in an uptrend, right? So what you want to be doing in an uptrend is wait for pullbacks or a price to come back down into demand zones. Well, this demand zone here needs to be respected, because in an uptrend, all demand zones are respected. And if you have a demand zone that broke opposing trends a swing high or area of supply. The only thing that can break supply is demand. So this is where your demand zone is. It breaks above. You don't want to just trade the retest of the line, and I'll take you back to my 240. You don't just want to trade the retest of the line. There's no demand there. Let's make this a bit bigger. So you're told to buy the retest of the line somewhere around here. You're told to buy right here. Where on earth within this rally is a demand zone? Well, there's a demand zone right here, this rally-based rally, or this bullish rectangle. Once again, you don't want to buy the breakout, guys. You want to wait for price to come back down and then bounce from there. But in this case, you did get a bounce, but it didn't make another swing high. It didn't break the. It didn't make another. It did not make another higher high. It didn't break the swing high here. There's your demand zone. It broke it within. After that got broken, right here, that's a pocket of air until you get to your area of demand. Hold on. This is a pocket of air. There's no demand zone here. There's nothing. So why on earth you would buy here makes no sense. There's nothing that's going to hold demand or make price reverse from this fall up until you get down here into the origin of the rally. There's nothing in between. So you're told to buy this retest of the line. That makes no sense. This is where demand should have held, and it didn't. So you wait for price to come back down into demand to do something, and then that's when you buy to the upside. So that's where you get the handle. Let me make this smaller, and then you'll see where the handle occurs. So you get, here we go. You get your swing high, because that's just, let's go back to the daily. After this massive rally, you come into supply. Right here, opposing trend supply, so price is going to fall a bit, but you're in an uptrend, so it's, you have demand zones. Let me paint this red. So if you're in an uptrend, you're going to have demand zones holding price up, right? You have here, you have here, you have a lot of stair steps, which is why pockets of air are great, but they're unsustainable. What you want is actually, what you want is this. This is a very There we go. This is a very sustainable uptrend because you have a lot of demand zones along the way. That's actually what you want to be seeing in terms of long-term growth. You don't want to see huge ballistic moves because then you get stuff like GameStop where it goes up 1,000% in 5 days and comes down faster. So you get your swing high, which is going to be the left-hand side of your cup because price came into supply. Price falls, and then if it's in an uptrend, you're gonna have demand zones that are respected, and then within this you can get head and shoulders or an inverse head and shoulders. You do, so you get your swing low, and then if you're in an uptrend, then it needs to respect demand zones and break opposing trends supply zones. So here you have this rally, and then you're given a demand zone right here that breaks the swing high. You come back down, giving you your handle. So here you have your handle right there in your demand zone, and here you have your cup area and then your handle, and then price goes. So you want to buy right here in this. So you want to buy right here in this demand zone, not because it's a cup and handle, just simply because that's your swing high. It needs to break that. This demand zone did, because a swing high is supply. It can only be broken by demand. So you buy areas of demand. And then if you get a higher high, then hey, what do you know? You have a cup and handle. That's just confirmation that you did the right thing, just to make you feel warm and fuzzy. But you should already be planning to buy there simply because it's an area of demand that broke supply. You're high on the curve, but you just broke this supply zone right here. So in this uptrend, up until this point, let's just say up until this candle right here, let me make this a bit bigger. Up until this candle right here, here's your area of demand, overwhelming demand, and that's your area of supply. So right now we're in the middle of the price curve. You don't want to be buying or selling here. You want to be buying down low and consider selling if price does a few things, which is breaking an uptrend, and it didn't in that area. So you want to be, this is where supply exists, this is where demand exists. Whenever, and notice how you wouldn't have shorted here, because just like you went long this area of demand because downtrend got broken right here. Supply exists there, but Did the uptrend get broken? No. So you hold demand zones, and this is the demand zone that broke your opposing trend's swing high or area of supply. So it broke the supply curve. Now all you have left is just demand zones. So you get a demand zone. You don't buy the breakout or anything. You wait for price to come back down, and then you just have fun with this very nice rally to the upside. And we already covered this is where you want to be. This is your area of demand, and we already covered these two entries on the last example. So that's how you see, or that's what a cup and handle looks like. Let's go over an inverted cup and handle. All right, so this is an inverted cup and handle. It's a continuation pattern. So you have your downtrend, you have your cup, and again, there should be a nice smooth U, but I only have straight lines. So you have your opposing trend swing low, it breaks it, and then it comes back up a bit, giving you your handle, and then it falls. So I'm going to be talking about this area here. So that's well, let me identify the first trend. So here's your first leg. Here's kind of your cup area. And again, when it comes to live price or actual price action, it never looks just as pretty as the poster representations of it, right? And then your handle area. So you'll see how this is pretty much a perfect inverse of the normal cup and handle that we saw last example. So here you have you're in a downtrend because you have a high, low, a lower swing high, and a lower swing low. So you're in a downtrend. So what you want to be doing is shorting supply zones, and which is why you see this leg had a rally base rally. This supply zone, or the origin of this leg to the downside, is right here. That's where supply exists because it broke this rally base rally. Hence why another reason why you don't want to be catching the breakouts of these formations, because you get smashed. You want to be using zones on retests. So this is what kind of holds the top of the cup, which would be this area. It holds this, and then this demand zone right here, which is the low of the price curve, needs to be broken because we're in a downtrend. So actually that should have remained green. So demand zones need to be broken and supply zones respected. Well, where's the area of supply where's the supply zone that broke this area of demand? Right here. This drop, base, drop. And it holds. That's where you want to be shorting. And then that becomes the handle, or the area where you should be shorting on retest. What you are told to do is right here, you're told to wait for price to break below this swing low. And actually, let me draw this out on the 240, just so it's a bit easier to see. Here's your swing low. What you're told to do is literally short after one massive drop, which is just, you're getting set up for failure here. After price breaks this line, you want to wait for the retest and then short here and expect price to keep on falling. Well, it's not going to do that. It needs to enter an area of supply. If you were going to short that aggressively, that low, this would have been your area. And it got broken because you're in a mini uptrend right there. Like, you had no reason to go long, or I'm sorry, to go short, because this trend was still being respected, right? Remember, in an area of supply, you want to wait for price to come back up, so it needs to create an uptrend, break that line, and then short the area that broke that line. So price price never broke this uptrend or this uptrending trend line, so you would never short it here. But that would have been the area where you wanted to short, not right here at the retest of that line. That, again, you're shorting way too low. You're told to short right there, but that makes no sense. What you want to be doing is wait for this general area of supply, this drop, base drop. Don't catch the breakdown, right? The breakdown would have been right here. You don't want to short the breakdown of that. What you want to be doing is using this area. This is, again, multiple time frame analysis. That whole area, on a day, oh, that's your daily supply zone area. So that whole area is this area right here. Actually, it's a bit smaller. It's right there. That's your area. Notice your supply zones are here. You have the origin, and then this drop base drop, and then within this area you're also given this one. You want to short there, and then when price re-enters, it also comes back up into here. So you shorted this, you made a very hefty profit. You know, from supply all the way down to demand down here. Hey, no joke or no coincidence. When it comes into demand, it rallies, right? But let's say you shorted here and then you sold or bought back to cover, buy to cover right before demand. That's at least 15 to 1, guys, or 10 to 1 in 3 days. 10 or 15% in 3 days. Not bad. You're beating the S&P by a lot. So that's really nice. And then when price re-enters here, let's say that you shorted here, but you got stopped out. You have this supply zone here too. You short here, and then you really catch a really nice runner. And hopefully you have a trend line on, you know, right here if you're in that position to take you out for profit right here. So that's how you're supposed to do it. You're not supposed to trade the breakdowns. You're gonna be set up for failure. So that's what those structures look like. The bullish and bearish rectangles and the ascending and descending wedges and bullish and bearish pennants, guys, they're just rally-based rallies and drop-based drops. Don't really worry about the structure. The mechanics are the same. Is it falling, basing, and then falling, or is it rallying, basing, and then rallying? If it's falling, it's supply. If it's rallying, it's demand. Don't catch the breakouts or breakdowns of those areas, guys. The move has already been done. Wait for price to re-enter those areas, and then wait for that trend line that sent price into those areas to be broken. And then if you're going, let's just say it's a rally-based rally, then go along the demand zone that broke that trend line, that bounced out of demand. You can replay that if that didn't make a lot of sense the first time. You want to be using those areas as supply and demand zones, not as entries to go in or go, not as entries to go in. It's just because a structure exists doesn't mean you should be playing it just because it's a structure. They're areas of imbalance. That's what we're gonna be looking at it, and the only way you play those is on retests. So I hope this was helpful on identifying rally-based rallies. Already covered the 3 different variations: ascending triangles, descending triangles, cup and handle, and I think that was about it. That was the and pennants too. But again, rally-based rallies and drop-based drops. So don't get caught trading on the wrong side. Use those areas as supply and demand on retests, and I'll see you on the next one, guys. Hope this helped you with your continuation patterns. Take it easy.